Carrie and I really look at markets in two different ways. Carrie has moved towards a fundamentals analysis of a stock, a company. He believes earnings per share, revenue, forward earnings, projections, that kind of thing can really predict a stock price. And to me, there is a part of that is very true. Then there's the other side of it, and that's what I believe in. I got into this business 25 years ago, became a financial advisor, and really gravitated to technical analysis. I believe markets are dependent on supply-demand, and that can easily be seen through the technical moves in a stock price, commodity price, futures, all behavior. You look at your kids, you look at your family members, and after a while, you see patterns in their behavior. My wife knows, after 34 years, how I react to certain things, how I react, how I'm behaving. She knows when I'm not talking about something, that something is really weighing on my mind. And when I do talk about something and I'm aggressive about it, she knows that is very important to me and it's a perplexing situation, or I'm super passionate and most importantly, very much believe in what I'm saying. Carrie and I have that in common for sure. He and I just look at the world differently. I believe that if you see a wave set, you'll see 7 wave sets before a calm, and then the wave sets will start again. It's a cycle of 7s. Markets do the same thing. Today I did a review on Riot Platforms, which is a crypto mining company. And I basically said, I'm not all in because it scores a 6 out of 10 of my scoring system, which is all technical based. And one of the biggest reasons is because yesterday, that was, what is today, the 24th, so the 23rd of April, Tuesday, Riot ran up to its 50-day simple moving average, hit a high against it, and then closed below that, down from that, at the end of the day. What that tells me, just after 25 years of experience, that the market didn't believe enough that Riot should go higher. There was not enough conviction. There was not enough volume. There was not enough buyers versus sellers. And so at the end of the day, it ran up, hit against the 50, and closed below its intraday high. Along with a number of other indicators, that told me that as we come up into earnings season for Riot, which is in the next couple days, I think next week maybe, it's not time to buy this. And that's where I use human behavior. And you can see that through technicals. The problem with fundamentals, in my opinion, is that there's so many unknown variables. It's a if-then statement. If this happens, then this happens. Well, we already know, for instance, Apple is having a big challenge with selling cell phones, the iPhone, in China because Huawei has come out with newer and supposedly better product, and because it's a Chinese company, it's winning out over the iPhone. When the Chinese government says you can't use an iPhone if you're a government employee, that's pretty much right in the sand. Remember, China is one of the biggest potential economies in the world, India as well. So we as US citizens are tight on money. Our 90-day credit card delinquency rates are through the roof. We don't have any money. So from a fundamental standpoint, Apple's earnings going forward are going to the rate of change is going to get less and less and less until it declines. They are, from a fundamental standpoint, basing decision, their fundamental situation is affected by so many other variables. When I look at it from a technical standpoint, it's obvious. It's trending down. It hit its peak in February, and it has trended down since. As has the semiconductor, a lot of semiconductor companies like Nvidia, SMCI, they're all trending down. I mean, SMCI has been on a 6-week negative trend. Yeah, it's bouncing back from its Friday sell-off of 20 some odd percent. Holy crap, right? And it's trending back higher. It's higher up yesterday, it's higher up today. Most likely it'll be up higher today. But chances are, once it comes against the 9-day simple moving average, it's going to retreat. It's going to hit a wall. And you can see that through the 10 different indicators that I use to make these technical decisions. It's not emotional. It's not, ooh, they could change the world. Oh, they could sell more computers to all these data centers and use more GPUs from Nvidia. No, it is supply and demand. And when there is not enough demand versus the supply, what happens? You stock prices don't go up. It's really not that complicated, yet it's so complicated. And the biggest complicated part of the whole thing is your emotions. Most investors, most financial advisors, most people who are in this game are playing a if-then statement. They're playing that routine. Yeah, well, what if, this $10 million house behind me, there's a lot of money on the sidelines that could come and buy that house. Well, if you're a business owner who could afford a $10 million house and your business is basically screaming because the cost of the money that you borrowed over the last 3 years is going up, and you have to refinance that debt, which I believe this quarter, second quarter, there's about $800 to $900 billion in commercial loans that have to be refinanced, that they were borrowed at 2-3% 3 years ago. Now they're having to refinance them at 5, 6, 7, 8. In some cases, really high level risk assets are in the double digits. You can't buy a $10 million home. You can't. It's just not in the math. And that's where I argue the fundamentals are maybe at the most 20% of a decision-making part of the process in this market. The other 80 to 90% is technicals. You think about the evolution of high-frequency trading. What is it based on? It's based on mathematical formulas. Jim Simons of the Renaissance Fund, he's in the 60s, he was a code breaker for the US government. He is a mathematician, PhD, brilliant, mathematics, doesn't wear socks. Go check him out, Jim Simons, Renaissance Fund. He started their fund based on math back in, I believe, 79. He is the best investor year after year after year in returns than anybody. He trumps Warren Buffett, which everybody thinks he's the best. He's a value investor, holds stuff because he thinks out 100 years. Are you gonna live another 100 years? Jim Simons based his fund on mathematics, probability. You can't argue with ones and zeros. It is what it is. And when you look at these markets, you have to start thinking supply, demand. Take in account money costs a lot. Inflation is high. I mean, when you have a US dollar that is basically worth 70 to 80 cents on the dollar, on average is, actually it's not 70, 80 cents. I actually did a video on the two regular guys show that I do with Mark yesterday, is actually worth $1. US dollar versus Euro dollars is worth 93 cents. So it's 7% less than what you have in buying power. You couple that with true inflation, and if you use the calculation of inflation based on what it was in the 70s, inflation's 18%. Add another 7% to that, and, well, you're fighting an uphill battle. That means the S&P, just to outweigh the devaluation of the US dollar, you have to minimum get 12% just to get above. And so if you're not using math and technical analysis to make your investment decisions, and I think the most misunderstood thing about best of US investors is that we're day traders, that we're swing traders only. I am a long-term investor. I'm not a swing trader for the most part. I am a long-term investor. I'm looking out 10 years from now when I'm 65 years old and I start a new chapter of my life and I want options. And so I'm looking out long-term. What is that behind me going to do over a longer period of time, over an intermediate period of time, which is 90 days or more, not what's happening this week. Our swing trading program is second to none. It is spot on. Mark is excellent at it because that's what he does all day long. That's what his focus is. That's where his mindset is. That's what his background is. It's what he does, and that's why there's a winning part of that. But the other elements of best of US investors is thinking about you in the long-term perspective of your investments and creating wealth and fighting the tsunami that potentially could be behind me and winning in that tsunami. So rethink your thinking. Step back, look out on the horizon and ask yourself, am I going to achieve my goals following the path that I'm presently following? Or do I need to investigate? Do I need to be curious about how my money is being invested and managed? And is there a better way, and how can I better myself than I was yesterday? Live loud. Peace. We'll talk to you later.